Okay, guys, what's going on? Jay here from smarthelping.com, and we're going to go over the Marketplace Plus subscription financial model. This thing is amazing. I basically took my most thorough and well done SaaS model, which was Enterprise SaaS, and I added a marketplace logic configuration on top of it. So this model is great if you have a marketplace that has an option for people to also subscribe and use the marketplace. It works if you're just doing a SaaS or subscription model alone with no marketplace. It works if you're just doing a marketplace with no subscription, and it works if you have a marketplace with subscribers. So it's very dynamic, really cool. I'm going to go through here and just fill every single assumption out so you can see how the model works. And this is a blank template version. If you want to get the template, the link will be in the description box below. And let's get on with it. So first we go company name. We'll just call this Marketplace Combo LLC. Launch year, let's say 2024. Now this launch year is going to drive all the drop down dates in all these different tabs, and it'll update automatically as you change the launch year. We have exit month, we'll just do a 5-year, so we drag that all the way down to 2028. Include terminal value for now, yes we will, and it's based on a trailing 12-month revenue multiple. We'll just put 1.2. Now cash sources, traditional debt funding. I'm actually not going to fill this in until I see what my equity requirement is, which will be, I'll know that after I fill in the rest of these tabs. Tax rate, yeah, we could put in maybe 25%, 10. And then customer receipts. So this is if on your subscription you have, say, 6 and 12-month terms or anything more than a month where you collect all the money up front rather than over the contract life. So if you do collect all the cash up front for contracts that last more than a month, you hit yes here. And this would mean like if you have 12-month contracts, all the cash for that full 12 months will be collected on the first month. And if you hit no, it'll just be amortized over the life as far as the cash flow goes. We'll put yes here. We have our sanity checks. These should all be zeros, and this will not be a div error once we finish filling out the template. Okay, so first tab for configuration is subscriptions. So here I can have up to 3 customer tiers, and I'm going to say for this marketplace, and you can see we're only editing the yellow cells. We're going to start each one on the January 24. But it could be any month. We're going to say, so I'm going to do a simple configuration. This is going to be month to month as the first tier. So we'll just put average contract length as 1 month. Then for the second tier, I'm going to say these are going to be people who sign up for 6 months. Maybe they'll get a little discount. And then tier 3 is going to be 12-month contracts. And the retention rate and all that is very important. That's why we have to segment these out for different configurations because the logic, you can't just apply a standard churn rate. You have to take into account when those renewals happen if you have multiple months for the contract term. Okay, so we have month to month, 6 month, and 12 month. Now we have starting our organic customer count. This allows you to say if you have specific, let's say, organic sign up pages to the marketplace or whatever, and these are this is just traffic um, or organic signups, not from ad spend or anything else, that just sign up to these specific subscription tiers. So let's say we start with 10 and then we increase that by maybe 0.1%. And we could say maybe we improve that by 10% per month. So we're compoundedly adding more and more organic customers to the subscription version. Now the subscribers, all subscribers, it is assumed that they will be active on the marketplace and will go through the configuration for the activity of subscribers within the marketplace. We also have different assumptions for non-subscribers that are active in the marketplace. Okay, organic growth of customers. You also have ad spend. Let's say you want to spend $5,000 a month in ads for these customers. We'll say the cost per acquisition's $5. So this is going to drive your customers acquired through ad spend of subscribers, and we're just going to do the same assumption. So I'm just going to go. Well, actually, let's just finish filling out tier 1. Now, average contract value. So these are month to month. So here you want to say, well, what are they paying every month? Let's just say here it's going to be $8.50 a month. We'll give these some decimals. We'll give all these decimals actually. Okay. Oh, where's our custom dollar value? Here it is. And then we'll say the contract, actually, the value is not going to change over time. Then you have your monthly amount right down here. Okay. And now I'm just going to say, well, let's continue. 0%. So this allows you to say every renewal, does the value that the customers are paying increase at all? It depends on what the business is. I'm just going to put 0% here and just assume the amount they pay when they first sign on is the monthly amount at each renewal. Retention rate. So this is very important. Let's say it's 9, and this is the retention rate for the contract term, which is 1 month. So if I put in, let's say 98.5% here, that means that every month I retain 98.5 or 2.5% of the original total of the cohort. Now I'm going to say this is going to be static. So we'll do 0% change in that over time. Okay, tier 2, we're going to say maybe these start a little bit higher, 50. We'll stick with the 0.1% with a 10% improvement in the growth per month. Ad spend, maybe we spend on these target maybe a little bit less, maybe $1,000 a month. CPA on here, maybe it's $7. And improvement CPA, we'll do 0. And now the average contract value here, it's 6 months. So in theory, if you do the average here times 6, it should be 51, but maybe we give them a discount. Maybe it's $46. And we'll do a 0% change in price for that. And we want to, where's our custom number? So now monthly, if you sign up for 6 months, you see it's only $767 instead of $850. All right, we'll do 0% here. Retention rate, maybe on these that pay every 6 months, maybe it's a little bit lower. Maybe you retain 95%, which was still really good. 95% every 6 months. So you're only losing, in this case, 5% of the initial cohort amount every 6 months. All right, tier 3, we do 12-month contracts. Let's say we start with 10 here. Do a small increase. And this doesn't change, which is 0 on this one. Ad spend per month. Maybe on these 2,000. And CPAs maybe $11, a little bit higher. I'm actually going to add decimals to this as well. Oh shoot, what did I have for the second one? 7. Okay, so we had 5, 7, and then these are a little bit more, 11. Average contract value now, well, we know 46 is $46 for 6 months is $767 a month. Maybe for 12 months we go to 75. Let's get the decimals in here. Okay, so $75 will do 0% change in that over time. 0% change in this, and then retention rate here, our yearly, let's say 80%, which is pretty solid. It means every 12 months you lose 20% of the initial cohort that signs up each month. All right, so I've got some subscriber assumptions here. Now note, you don't have to actually use ad spend here on organic traffic. You could zero those out, because now when we go over to the marketplace tab, you have assumptions to drive subscribers that sign up from these traffic sources, as well as a percentage that sign up from they leave from being a non-subscriber marketplace customer to a subscriber marketplace customer. So you could just drive your subscribers from that, and you would then only need to use the subscription tab to figure out your contract terms, like this value. But you wouldn't need any of this. So it's a very flexible template. Make sure you're not double counting anything. This is essentially, this ad spend and customer growth is separate from what we're about to do on the marketplace. So now we're on the marketplace assumptions. Let's say we're going to spend, I'm just going to say $10,000. Now you can adjust this every month over 60 months. I'm just going to do the same value. So ad spend $10,000 a month. Let's say traffic from ads, we get 50,000 a month. Traffic from ads, sign up conversion, let's say 2.5%. No, actually, let's say 1.5. So I'm spending $10,000 a month. I'm signing up here 750 customers a month from to the marketplace. Now let's say we have organic traffic. It'll probably change over time. Let's put 500 and then just increase it a little bit each month. Now again, you'll have strategies and plans for all these numbers. The point of this template is to allow you to drop in the numbers that you come up with, and it works correctly. Okay, so organic traffic from organic sign-up conversion, let's say this is a little bit higher, maybe 3.5%, because the conversion for organic is always going to be higher than ad spend. So you got that, expected traffic from there, average sign-up rate across all channels that we just defined is 1.52. Now percentage of customers that sign up direct to subscription. So these would be, if we put, let's say, a 0.05% here, it means in this case, you're signing up 25 people that are coming onto the marketplace, and they're also going to sign up for a subscription, tier 1, 2, or 3. Now you can define the percentage of new subscription customers signing up to each tier. So this number and the amount that goes to each one, maybe 20% go to tier 1, 30%. Actually, no, let's do, most people do month to month. Let's go 70, 20, and 10. And we could change that over time or keep it the same. And all that means is every month, these customers that are signing up to the subscription service, this is which tiers are going to for a month paying subscription fee. Okay. This is allow you to show the average lifetime of a marketplace customer in months. So what this says is if anybody that is a new essentially sign up to the marketplace, on average, how long are they active on the marketplace for? Here I just did 33.333. It's essentially saying roughly a one, you're losing a third every year. You could also put, let's say, 48, the even number. So this says on average, marketplace users come on and they are active for 48 months. Now, I did make a dynamic retention curve on the validation tab. So this uses the 48-month number we just put. You can see here it goes to 48 and then you're out. So every single new customer follows that retention schedule. You could modify this. So if you have a high drop off in the first few months and then it kind of levels out, you can do that. You could hard code over this and that's fine. If you do hard code over column AD, and this is just for the marketplace, these are for the subscription tiers, which you could do the same thing in theory. These just use the flat retention rate driven from the retention rate that's input here on this configuration tab on the subscriptions tab. But you can hard code those in if you want, and the customer life will follow whatever is in these columns, whatever percentages. And what this is saying is just when someone comes on, how many of those customers in a given month that existed are still there after this amount of time has passed. And remember, tier 3 is every 12 months, so you're doing every 12 months here how much are left. Tier 2 is 6 months. This is how many are left after every 6 months. And then tier 1 was month to month. And then the marketplace is not a subscription necessarily. They might be a subscriber, but if they're not and they're just using the marketplace, this is just trying to say how long does a customer use the marketplace once they sign up to the marketplace. And that can be defined here. Okay. So marketplace. Now we got to configure what actually happened when they joined the marketplace. So here, configurations for marketplace, non-subscribers. So people who are not subscribing to anything. What do they do? Well, we could say maybe 15% of them transact on the marketplace. We could say that maybe the average value is $40, and we could say the average transaction per month per customer. Maybe it's 3.5, whatever the case, and these numbers can change over time as well. And then this is your revenue you're making from the marketplace. So what are you, as the marketplace facilitator, going to charge for all these transactions happening? And maybe you charge non-subscribers maybe 4%. Okay. And then we'll do the configuration for the subscribers, and then we'll be ready to move on to the rest of this. Oh yeah, and we have percentage of ongoing marketplace customers sign up to each subscription tier. So this says of the balance of people in the non-subscriber marketplace pool, how much of those people just decide at some point in the future are they going to be a subscriber, and if so, what tier? So we could say maybe 0.1% go to tier 1, 0. Well, no, it's going to be more. We'll say 0.2 go to tier 1, 0.15 go to tier 2, and maybe 0.05 go to tier 3. And you'll see how all these numbers flow once I get to the monthly detail. Okay, last configuration here is for subscribers. So here we could say maybe 25% of the people subscribing will transact every month. Maybe their average value is a little bit higher, maybe $65 a transaction. And again, these are arbitrary. This is going to depend on what your marketplace is facilitating and all that kind of thing. Average transactions per month, maybe these are a little bit higher, maybe 6. And then transaction fee charged to subscribers, and maybe since they're paying you a subscription fee, you only charge them 1%, or maybe 0%. It could be 0. So non-subscribers, we're saying less of them actually transact. The value's less. They transact less per month than subscribers, and they are charged a higher fee since they're not paying any subscription fees. Okay. Now, customer service reps here, all we're saying is how many tier 1 subscribers are there? How many customer support people do you need? So if I were to put 0001 here, That means for every 10,000 customers, subscribers in tier 1, I need one rep for every 10,000 customers. Then you can put fully loaded salary. You can also do another customer support person for tier 1 if needed. I'm just going to do tier 1. We're just going to do the same thing for tier 1, 2, and 3. And then also you're going to have this for marketplace people. So this is non-subscribers that are in the marketplace, and what's the customer support people you need for them? Maybe it's even lower. Maybe oh, we don't even have enough decimals for that. I'll add one more. Oh, wrong button. Okay, so this is every 100,000 users, non-subscribing marketplace users, you need one of these, and their fully loaded salary, let's say it's 45,000. Now the improvement, if you were to put 1% here, that means over time, the reps you have are able to handle more people. Okay, I'm gonna just leave the rest of these blank. Sales, I'm gonna leave this blank for now, but if you were to say you needed a certain amount of salespeople for every subscriber, you could put that in here. So for example, let's say I put 0.05. That means for every 20 new people coming onto the subscriber portion of the network, you need one sales rep, and you can put their salaries, etc. And you could do, there's 2 different sales rep types for each subscription tier. And note on this, I did not add a sales rep for the marketplace, so that doesn't really make sense. It makes sense for customer service reps, but not really for sales. So these are only the sales tab. This only applies to sales headcount in relation to the subscription tiers. Other costs. So let's say we got marketing. I'm just going to stagger these like this, and you got your whatever these costs are. We could put in here. Over time, maybe you zero these out. Okay, and then I'm just going to do the same thing for G&A and R&D, but you would have these, you would want to go through and actually, figure out what types of headcounts you need, put them in here, put the start month, put the monthly cost each year. And this would be the fully loaded cost if it's a salary, meaning you need to include payroll tax and benefits. Okay, and then you've also got function totally monthly revenue. Let's say this is payment charges is, let's say 2% of revenues. Put 0% for this. And we can just have these start the same month. Cost of goods sold. Now this is an interesting part. So here, you can account for costs per active customer for subscribers, tier 1, 2, and 3, and for the active marketplace customer that's not a subscriber. So this is, let's say, Amazon or whoever you're using for your hosting, it'd be like maybe these are all the same, $2 a month. Maybe these are a little bit higher, $3 a month per customer, or whatever it is. It could be lower, it could be higher. What this is doing is just saying, what does it cost you to service these customers over time per month? Okay, debt schedule. So here, I'm just going to put in some loan terms. Just put a 30-year loan term with a 5% interest rate, 12 payments a year, and we'll start the payment date on this date. We haven't actually entered a finance amount yet. We will later. CapEx. So here, if we're buying a building, if you're not buying a building, maybe you're doing office rent, that's fine. Then you would just put in other costs you'd have under G&A, office rent in one of these, and then put what that is over time. But if you're buying a building instead, you can enter that in the CapEx. We're just going to assume these all happen in January, and let's say the end value is that. Now let's say you also have computers, maybe $50,000 in computers and equipment, maybe another 50,000. Useful life here, 7 years. And we'll put that these are just all bought in January as well. But you can fill this out. These are just the depreciable items. So you put the cost, useful life, month of expenditure, and then this top row is just the value at sale for the building. The value at sale for the rest of these will be dependent on the terminal value tab. If you put, let's say, 95% here, then it's going to apply 95% to extraordinary income and the other 5% to the CapEx items. And then you'd have now, you can see we've got a value at sale for those based on what we just entered. If you're not really worried about taxes on the model, that's fine. Just put 100% here and it will be irrelevant, and you can zero these tax rates out and it just, no taxes will populate. All right, so CapEx, cap table. So here, interesting one. Let's go 100 shares. Let's say it's all common stock. Right now, the model is saying we need $744,000 to get off the ground. The last row here in the outside investors is overflow. So let's say anything that hasn't been contributed by owners or the other investors will flow to here. So you've got outside investor contributions and their percentage share, and then insiders, founders, their contribution and share. So we'll just do really simple. Let's say they get, these investors get 30%. Let's say the founder's going to put in 100,000 for 70%. And that's it for this. And then you can see down here to check it, make sure these should be 0. These should be negative 100% if you're not using them. That's fine. 0 or negative 100. And that's the most simple way to set this up. Now, if you want to do other rounds here, you can enter amounts in, and remember, if you put in, you'll have an error in the sheet if you put in more contributions than you actually need based on the minimum equity required. If you want a reserve, you could go on the startup costs, which is the next tab, and enter a reserve here. So that would that say, let's say we put 150,000 here. That means that technically when your balance sheet says you have 0 cash, you actually have 150,000 extra dollars. Cap table also has a distribution summary and an internal rate of return for each individual row, as well as the aggregate outside investors and insiders. You can see this 42.3 and this 230.6% will match your distributions. These don't have decimals, but it's the same numbers here on the discounted cash flow analysis. But let's get to that later. Okay, so that's all you have to do here. Just essentially make sure the totals of your funds contributed here and here should equal this. The overflow helps you by just doing whatever you haven't entered or the amount remaining in here automatically. And then to find the percentage they're getting in column D. Right there. All right, startup costs. So let's say web design, 20,000, more 50,000 for this. Whoop. Okay, maybe legal fees and whatever else you have. These are just costs that you haven't entered anywhere else that you need to account for. Terminal value we went over. And now that we've entered all our assumptions, all of these summaries are going to populate. So if we look, we have an income statement now. You can see our subscriber revenue, our marketplace revenue, cost of goods sold, operating expenses, depreciation expense, and net income over time. You can also see on the annual, here's the annual summary, subscription revenue, marketplace revenue. And these are all based on the assumptions we just entered on all these tabs. Here you've got your exit. balance sheet, you can see cash, all your CapEx, capital assets, accumulated depreciation, unearned revenue. So here, because we are doing 6 and 12 month contracts, there's revenues that are unearned here because it's just a running balance of what you still owe as far as services relative to what you have collected in cash. So this is a liability. You've got equity, retained earnings, and then liabilities plus owner's equity equals total assets, and that's the check for that. Balance sheet annual will show the same thing. Cash flow statement monthly, this is kind of like your uses and sources of funds. It's showing you all your activities from operations, investing activities, and financing activities. This flows over to the balance sheet to populate the cash position row here. And all these income statement, balance sheet, cash flow statement are all connected together properly with the proper formulas. And so you can see here, cash flow statement, you've got your, now for operations, we're reducing any receipts collected up front. Well, we're saying that this is the total collected up front. This is the total that was not collected yet. So this is your reconciliation if you look at the monthly. So here we have 13,500 nearly, but we actually 11,000 of that oh wait, sorry. We have upfront collections here, and we have the monthly detail showing you in E350. This is the initial amount collected. Whether so if it was 12-month contract, this is total collected on a 12-month rate at the beginning, and this is what that equals every month across all the different subscription tiers. This is what you're actually receiving, or this is like the amortized amount. This is what you're collecting up front. This is the net change in cash flow that you need to apply. So if we look at the balance or the cash flow statement, 13,496 is your total collected from here, 11,000 plus your marketplace revenues, which would be 2,029. So that's where you get the 13. Okay, then you reduce the 11,467, so you're zeroing out the subscription revenue, and then you're adding back the total subscription cash collected, even if it wasn't, this could be 12 and 6 month contracts and month to month, everything you collected in January. So the reason why the customer receipts is higher than the reduced receipts in this case is because on the marketplace, marketplace is always whatever you get in the month is what you get. It's a transaction fee. So there's no subscription on that. So you can't just reduce that out. It wouldn't make any sense. But you can reduce out the subscription revenue and then add in the subscription revenue collected up front here. And that's why this all balances out correctly and matches the income statement. Now the income statement, this is all amortized values. So if you're collecting cash up front, this is still going to show you what you're actually earning over the period of the contract, not the total cash. The cash flow statement will show you the total change in cash over time. Okay, so there's that. Executive summary, just high level, we've got total year-ending customers, marketplace plus subscribers, total revenue, cost of goods sold, gross profit margin, general administrative expenses, sales and marketing, R&D, total expenses, EBITDA, which is earnings before interest, tax, depreciation, amortization. Debt service coverage, we didn't put any debt in. Now would be a good time. We can go to global control and see, well, we have to come up with a $979,000. What if we do $250,000 loan? Now our debt requirement has gone down. We now have a debt schedule here. And have a debt service coverage ratio. Then we got all our other cash flow items on here: taxes, capex, debt service, all these things, total cash flow, and this cash flow will account for, will match the monthly and annual detail. And all of these sanity checks here ensure they're all 0. That means that the financial statements here match the executive summary and the distributions and the monthly and annual detail, which they all should consider the same data, just presented a little bit differently. Okay. We're just going to give these a little indent for proper form. You've also got IRR of the project and of the outside investors, insiders, their IRR, equity multiple, total cash returned, and ROI. We've got the project level revenue and EBITDA. Distributions, this is this kind of cash flow analysis, which you can do for the project as a whole and for the outside investors and insiders. Again, this doesn't have to be joint venture on here. You could easily, on the cap table, you could just put this total amount. You could copy it, paste values here, just say, well, the owner's contributing everything, 100% ownership, and 0 here. And that's fine. Then now if you go to distributions, the project level will match the owner level, same exact numbers. So that's how you do that if you don't have any outside investors. Let me undo this just so we have our default numbers in here. Okay. Visuals, key financial stats. You got your revenues, gross profit, EBITDA, annual, yearly cash flow, monthly cash flow. And again, I could hit not to show exit value, and then you can see just the operations in these visuals here. For cash flow, month-end customers, all customers, month-ending customers by tier, stacked. So this is showing you total customers and how much are from tier 1, 2, and 3 subscribers versus non-subscribers. You've got your percentage of customers. So you got your 3 subscriber tiers and then your non-subscriber marketplace users up top. Monthly revenue by tier. So what are you making? What's your total revenue made up of between the different types of customers, subscribers, non-subscribers, and each subscriber type? You got your customer acquisition cost, average gross monthly value per account. Now you can see, I'll show you why this is kind of going exponentially here, like this. I'll show you when here at the end. But customer acquisition cost, average monthly value per account, average months to pay back customer acquisition cost, average monthly churn, average life of a customer, average monthly churn in dollars, average lifetime value to CAC ratio. And then here's your basic comparison of subscribers versus non-subscribers, the percentage of each. Here's the actual count, the revenue made from each, and then the revenue from subscription revenue versus marketplace revenue. So subscription revenue is one thing. Marketplace revenue would be sourced from subscriber and non-subscriber marketplace participants. So this is a good view as well. Monthly detail, this is where all the really nitty-gritty gets down. You can see here's our marketplace non-subscriber pool over time. Here's our subscriber pool over time of marketplace users. You got marketplace revenues, and you've got non-subscribers and subscribers, their total transactions, the value of that, and the fees taken by the marketplace itself. This is the total revenue for the company here for marketplace transaction fees. You've also got your subscriber count, so tier 1, 2, and 3. And note you can see for each subscription tier, you've got organic growth and ad spend. These two are from the subscription tab assumptions. Then this one is everybody converted from a free marketplace and directly signing up to subscription tiers from the assumptions here would be this row. And then all this is going through a very advanced logic for the retention of customers over time to figure out what you're losing in customers each month, and then your ending count for each subscriber tier. And note the total end month subscribers is going to always equal the subscribers in the marketplace. So this is like 4223. You see here, this is 4223. So that will always match. And on here you can see where are your marketplace subscribers all coming from. You've got new marketplace subscription customers from traffic. So this is from the marketplace tab directly coming in from this assumption, which is this number here. These three are all coming new marketplace subscribers that have come on directly from subscription assumptions. So that is more of this, like this organic traffic, this ad spend for each of these tiers. And you can see, actually, no, sorry. These three are coming from people who leave the free marketplace and decide to be subscribers each month of the total marketplace count. So this is taking into account the starting non-subscribers in the marketplace, and some percentage of those convert to subscribers each month, and that is this. So that's why these are highlighted, because this is the same. And then this one, this $13.95 is what's from the subscription tab. So this is coming from the organic traffic and the ad spend here. Okay, and then churn rate. This is, again, the churn rate of marketplace users is always based on this once they come in. Now it's a little tricky because you've got that churn rate. Well, no, sorry. So the churn rate on anybody that's a subscriber, and the assumption is if you're a subscriber, you're participating in the marketplace. So this churn rate is based on all of these different retention rates plugged in here. The churn rate of non-subscribing marketplace users is from the marketplace retention here, the average life of a marketplace customer. Now, if a user comes from the marketplace and decides to subscribe, once they sign up to subscribe, they're now going through the logic to whatever is on the subscription tier for each tier 1, 2, and 3 that's defined. And again, the assumption is if you're a subscriber, you're in the marketplace. And so we look at the churn of marketplace subscribers as it's the same as the churn rate of the actual subscription tiers. Okay, so there's that. Marketplace revenue. Here's your tier 1, 2, and 3 customers over time. All subscriber customers. Then you've got your subscription revenues. And then down here you can see total subscription revenue, total marketplace revenue, and then total revenue of all. We've got some metrics here, average revenue per month per customer across all revenue types. Here's your cost of goods sold based on the dollar cost per active customer for each of the tiers and for the marketplace tiers. Customer service rep costs, gross profit. These assumptions just show you how the logic is coming up with how many customer service reps you have for each tier. Then you've got your general OPEX, so sales and marketing, G&A, R&D. You've got down to EBITDA, cash flow after debt service, startup costs, and then some key metrics down here: customer acquisition cost, average gross monthly value per account, months payback. So here's how we're calculating all those advanced metrics. And then here's our logic for if we're collecting cash flow up front or not. If we are not, these will be the same. If we are, which we are here, there's a difference in cash flow. And these are some more chart data pieces down here. Now, what I wanted to tell you, the annual detail, same thing as monthly, but just on an annual basis. And then note all these matrix tabs are how all this logic I just went over is working. And that's pretty much it. Now, so the reason why we're seeing this kind of exponential growth is because on these subscriptions, I'm saying that we are growing at 0.1% compounded. So that it's saying we add 10 in month 1, and then we add 0.1% more than 10 in month 2, 0.1% more than that in month 3, etc. Now we could zero these out and just say we're essentially adding 50. And now if we went to the visuals, you could see we're still exponential growth. Let me see here. So it's good to try to play with the assumptions to see what is driving the numbers. So if I look at my subscribers, I'm adding 10, 10, 10, 10 every time. Churn rate's around 2%, 1, 2. That makes sense. Let's look at our marketplace assumptions. Because I was growing these at an exponential rate, the organic traffic. Yeah, we started at 500, we end up at 520,000. So let's say, maybe we get to like 5,000 viewers to the site and we level off a little bit. Now let's see. Yeah, there you go. So now you see more of a level. Now it could be like that exponential if you think your organic traffic can grow. It's again up to your assumptions. But yeah, that's what was causing that. The subscription, you can see how if I put a 0 here, it's 10 a month, 50 a month here, and 10 a month here just for the whole lifetime of the template. And again, you don't even have to use these. You can drive your whole entire subscription business off of the conversions from your signups here. I just wanted to give two separate things so that you can use, let's say you didn't want to have a marketplace, you could just toggle these to do a subscription business. Or if you didn't want a subscription business, you could zero these out, zero this out, and zero these out. And then you would just have a marketplace only, no subscriber option at all. So that's completely possible. For example, if I clear out these, clear this out, clear this out, and we say 0 on these. Okay, well now, if I go over to my monthly detail, I have, where are we getting these from? New marketplace, from subscription tab. We have to zero out ad spend as well. Actually, we can just zero out the CPA. And now look at, there's no subscribers at all. We just have a marketplace driven by the assumptions we put in there. And that drives our revenues for marketplace activity, not subscribers. And that's all we have. And there's no subscribers. So very flexible model. You can do all kinds of stuff with this thing. I think it's really, really valuable. And have fun with it. Again, if you want the template, links in the description box below. There will be a one-time cost. And don't forget to like the video, subscribe, and I'll see you guys on the next one. I think I'll do, I'm working on also a subscription shopping model, which is a little bit different than this, and we'll see what we got next. Alrighty, take it easy.